Hello, Seb.
Hi there,
Hi.
Ollie. How's it going?
Yeah, I'm very good. Yourself?
Yeah, not too bad. Yeah, hectic day as
Uh,
you can imagine. Lots to
I
unpack
could,
and chat to clients about. But yeah, no, very, very good
yes.
otherwise.
Yeah, I can imagine it's a busy time for you guys over the next couple of days.
Yeah, absolutely. And so it comes on top of busy, year end coming up, and before you know it, kind of
Yes.
the tax year end too. And then yeah, this being thrown into the mix makes it exciting, keeps everyone on their toes, gets everyone engaged, which is an important bit.
Exactly. Yeah. But no, that's the thing. I think it's great to kind of get you on to kind of deliver how the budget is going to directly affect dentists in terms of
Absolutely.
yeah their remit, what they should be looking for, kind of yeah what's gonna happen possibly over the next 6 to 12 months.
Yeah, absolutely. It affects everyone. Practice
Exactly.
owners, be it whether new practice owners looking to buy, looking to sell, tax affects everyone. So there's a huge amount to unpack and almost follow on from last year to a certain degree as well, sort of seeing where we are
Yes,
a year on, and what's being added and bolted onto that. So yeah, huge amounts that affects dentists of all shapes and sizes.
exactly. Right, so I think just looking at the time, one of the one of the guys that I met a few years ago had a lovely phrase saying "Don't punish the punctual." So for everybody that is here on this lovely Wednesday evening, I think it's a good time to get started.
Fantastic.
So welcome everybody to our budget update with Seb Stracey from Humphrey Co, who is a partner at Humphrey Co Chartered Accountants, who's going to run us through the autumn budget update, which came out this afternoon, and specifically how it pertains to dentists and dental practitioners and people in the dental world. And as you've just alluded to, obviously tax affects everybody, no matter what role you're in. So there'll be some, I'm sure, good nuggets for people to look for to pick up on, no matter whether you're a principal, whether you're an associate, or just kind of in the dental world. And then also looking at any strategies that would be good over the next year to kind of employ yourselves and yeah, just to be generally aware of. So
Super.
that's probably enough from myself and over to you, Seb, and see you in a little bit.
Fantastic. Thank you very much, Ollie.
Thank you
Good
very
evening,
much.
everyone. Thank you for joining on a Wednesday Eve, probably slightly chilly winter Wednesday Eve. And yeah, just in the wake of the budget, the much awaited budget. So before we dive into that, just a bit of background. So yeah, I'm a partner at Humphrey Co. So Humphrey Co, we are one of the largest, if not the largest, dental accountant in the country, backed for over 2,000 dentists, all shapes and sizes, from FDs, therapists, hygienists, and associates, all the way through to mini corporates, and lots of practice owners in between of all shapes and sizes. So yeah, there's not a huge amount we don't know in the dental world. We see a lot, particularly this time of year where it's extremely busy. Talking to a huge number of dentists, getting their feel for things, and particularly today, budget day, which is always a very exciting day for various reasons. Exciting being used potentially in inverted commas there. But a very exciting day because there's lots going on, so lots of queries, lots of feedback, and working out how the Chancellor and what she's announced is going to affect our clients and their businesses and what they can do. So I've put my email address up on the screen. Hopefully you can all see the slides. My email address is up there. I'll pop it in the chat box at some point too. So if you do have any questions, I would absolutely encourage you. We'll have a Q&A at the end, but absolutely encourage you to ask questions as we go along, and I'll pick things up. I like to keep things fairly informal, so I'd rather kind of make this as relevant to those in the room as possible. So please do ask anything as it comes up. Or yeah, as I said, equally, if you'd like to drop me an email, ask any questions as a thank you to all the guys at FTA, more than happy to field any queries if people have, particularly pertaining to the budget, but anything more broadly finance related. Um, so the key announcements, I mean, the way this is going to run really is we are going to be looking at this from almost a factual point of view, running through all the key announcements, and then as they come up, I'll kind of explain how they relate to dentists, what you can do, what you can think about, but mainly the impact. We're only a few hours out from the budget. Um, Probably half an hour earlier than normal actually from the budget. If anyone who was watching live, it was leaked by the OBR, Office for Budget Responsibility, a little bit early, which added some excitement to the proceedings. The fact that it shouldn't have happened, but yeah, we did get an advanced view of it half an hour earlier than normal this year, which sort of took the sting out of the tail a bit from the announcements. I'm going to go through it. pretty much in headline order. So starting with some of the things which are slightly more relevant, or some of the bigger headlines that you may be reading about or heard about already, and then explain how they tie into to dental, mainly dental practices, but also there might be some associates in the room or people uh, more interested just from the pure self-employed or limited company aspect if they have other businesses too. Um, so probably the big announcement I would say in terms of effect and impact on tax is the fact that tax thresholds, so these are your basic rate tax, higher rate tax, and additional rate tax bands, as well as personal allowances, have all been frozen for another 3 years through to 2031. Whilst on the face of it, that doesn't look too bad, it doesn't sound too bad. You're not getting a massive tax hike. They're not saying we're going to ramp up tax by 5, 10%. We're going to increase all these rates. They're not slashing anything. But the fact they're frozen does mean, in essence, you are being taxed more. If you think about inflation, if you think about wage growth, each year prices go up, which means people have to earn more to be able to afford the same amount that they did the year before. So if wages are growing, and lifestyle costs are going up, if tax thresholds aren't going up in line with that, it means that if your income is going up, more of your income is going to get taxed at higher rates if they haven't gone up accordingly. So you would think somebody who is on the basic rate band, so of say £50,000, someone who's on that basic rate band of £50,000 would hope that well, they're a basic rate taxpayer. They should always be a basic rate taxpayer because as their income goes up, just with inflation, so ignoring promotions and earning extra income, but if their income stayed the same, other than getting an inflationary rise, they would hope that they would always stay within the basic rate tax. But because these are being frozen now, so we're looking at 6 years now from now, you're going to find that that basic rate taxpayer ends up falling into a higher rate, which means more of their income is going to get taxed, or some of their income in this case is going to get taxed at a higher rate, which means they're going to be able to afford less than they did before. Because if you think prices of goods gone up, they need more disposable income to afford that. And if they're paying more tax, they're not going to do that. So this is what I would call a stealth tax rise. And I think that summarises this budget in the best way. I think the preamble and lead up to this really did focus on tax hikes, tax going up, the Exchequer having to collect huge amounts more money. And we didn't really see that. There is with one notable exception, but we didn't see tax rates, income tax, capital gains, corporation tax. We didn't see all of these going up drastically. But they've snuck this in, a freeze, which is essentially going to be collecting more tax and going to be taking more money out of your pockets in effect. So this is a stealth tax rise. There's no sugarcoating this in terms of planning points, what dentists need to think about. All the same things as before. Nothing's changed in that respect. If you are managing your income, maybe using a limited company or just in terms of how much you work, to keep below the basic rate bound or keep below the higher rate bound, so about 50K, you've still got to try and find a way of doing that. The key one is usually around the 100K mark, trying to keep your income below that 100K, which by the way has been frozen since it existed. Those of you not aware, around 100K is when you'll start to lose your personal allowance. So for every pound you earn over 100,000, because you're losing your personal allowance, where you're being taxed at 0%, there's an effective tax rate of 60% in total. Because you're paying 40% on the income over the 100, plus you're losing the 0% band and then suddenly paying 20. So there's an effective hidden rate of 60% already if you earn over £100,000, or between 100 and 125,000. And that's been frozen since it existed, as far as I'm aware. That's always been the case if you earn over £100,000. So again, this is another year where people have got to plot their incomes around that. And the problem is, like I've said before, and I won't hammer this point too much, but with prices of things going up, practice owners, all your suppliers, staff, etc., everything going up on that side. Personal income wise, it's the same. Cost of goods are going up. Mortgage interest rates still aren't coming crashing down. Um, Everything's going up in price. Trying to keep to that 100K is going to become even tougher because you may need more money. But all the same planning applies, as I said, really trying to keep below those rates and not cross over those thresholds unless you have to. So planning your income, planning how much you're withdrawing, when you're withdrawing it, how you're spreading that income over multiple years is still just as crucial now as it was before. So yeah, that I would say, my personal opinion, I would say that was the big headline for me. This sort of stealth tax, this is what's going to net them the most money, I would imagine. Um, and it's the one which the public might not pay too much attention to because it's not rates going up. Um, but it is still going to affect their pocket quite a bit. So that's for me, but the biggest headline, that's the biggest bad news I think that we saw from the budget. Um, the other thing which will grab a lot of headlines, because this, I mean, this was all but certain, I think, even before today. I mean, I spoke about the leak half an hour before the budget was delivered. I mean, this has been leaked and briefed for weeks, if not months now, that there was going to be a pension raid. Um, Again, the media love to get hold of this because when you say pension raid, it makes it sound like something quite nasty and potential to be really, really punitive. And this is tough, but again, it shouldn't affect too many dentists. So whilst it sounds really bad and may affect a few practices, so a few employers, on the whole, there might not be too big an impact, depending on how your practice is structured and how staff salaries are structured. So salary sacrifice pension contributions are going to be not capped, but up to £2,000 will be as before, and then anything above £2,000 will be subject to NI. So for those who aren't aware, salary sacrifice is a way of employees and employers saving national insurance because what an employee does is they say, or use an example, instead of their salary being 50k and you charge tax, NI, etc., and all of that, you say what we're going to do is we're going to pay you 45k, for example, and 5k is going to go into your pension. So actually, you get tax and NI on the 45 grand. Now, the tax relief you'd always get anyway, but it's the NI element that you wouldn't normally get relief for pensions. So salary sacrifice is a clever way of being able to save national insurance. And in terms of the chancellor trying to collect money, this feels like a relatively easy win because I feel like where salary sacrifice has been used or maybe even pushed and abused, particularly by a lot of large financial advisory firms where they're potentially dumping huge sums into salary sacrifice. This will claw a lot of that NI back straight away, which was never really the purpose of it. So salary sacrifice pension schemes, um, essentially, cap £2,000, but most people will go through that £2,000 limit quite quickly. So there will be additional NI, and again, no way of sugarcoating this. There'll be more NI if you're operating salary sacrifice pension schemes. Now, salary sacrifice in the past, not all employers have run it because it takes a little bit of time setting up. There's a little bit of cost involved, and it's a little bit more extra effort. So most people won't do it, and it's largely to the benefit of the employee. So a lot of employers don't operate it anyway, but there will be some that do. So if you do have employees on salary sacrifice, so nurses, etc., you might just need to think about this, look at the limits, look at how much the extra cost is going to be, and whether it's worth continuing doing this bit of admin to save everyone a bit of money or not. But like I said, I can't think personally of all the practices I act for, employers I act for. I would say it would be in the minority of those who are operating salary sacrifice. So not too big an issue. And they have given a bit of leeway here. I mean, this is going to start from April 2029. So to give people a chance to restructure things, take people off of these schemes, assess the risk, bake in the costs into their forecast. They have been given a fair amount of time here. So again, this is bad news, but this is 3 years away. This isn't imminent. This isn't going to hit books next year. And like I said, it shouldn't affect too many practices. But those who it does affect, if you have got a salary sacrifice scheme, the advice here, have a chat with your accountant, work out the financial impact, work out how much it actually affects you, and then work out what you want to do on top of that, or how you could maybe think about looking at things a different way to try and save some costs. Because yeah, I think if you are operating one of these schemes, you're almost certainly going to be affected. So then it's just working out the best way of approaching that and quantifying things normally helps. I think people often hope accountants will just have a magic wand and say, well, there's a tax rise, there's an extra cost somewhere, but don't worry, you can get rid of it by doing this. Most of the time, that's not possible because most of the time, HMRC and the Chancellor have already thought of those schemes that you might come up with. So a lot of the time, it's about mitigating it as much as possible, but then trying to soften the blow where possible. I think quantifying things often softens the blow. So if you particularly those first two, they sound bad. You think, oh, tax threshold, that's essentially tax going up. Salary sacrifice pension being basically removed. That's going to increase NI costs. Well, they sound really bad. When you actually quantify them, you might find they're a lot more palatable. It's still an increase. It's due to slow, and then you can bake that into your forecasts to make sure that you're not overly affected, or if you are, you might have to make some other changes. A little bit of a surprise to me, to be honest. I didn't expect this last year or the year before last. There was an introduction of a new British ISA, supposedly, and we've always been encouraged to save as much as possible. And now they've slashed the ISA allowance. So, for those unaware, you each year you can invest into a cash ISA up to £20,000 a year, and um, any interest that that receives is tax free. So it's a really good way, if you have substantial savings and substantial sums in the bank, sticking it in an ISA, particularly with interest rates as high as they are now, getting that interest tax free is really, really useful. Um, but that has now been slashed from £20,000 a year that you can invest down to £12,000. So again, people are going to have to think a little bit more about a lot more interest is going to be subject to tax. I think the figure the Chancellor quoted was 90% of people won't be affected, that their savings interest will still not be subject to tax because there's various allowances. Um, but who knows what interest rates might do? Interest rates could go up again, you never know. And likewise, a lot of dentists are probably in that 10% group where they've got substantial savings and they want to try and utilize ISAs as far as possible and actually be able to keep their interest outside of it. When does the cut come in? Good question. I believe it's next year, but I will double check that and drop a follow-up email around. But yeah, I believe it was from next year that they were looking to do that. Most of these changes are usually within the next year that they bring them in. I will double check that the exact one on that because I actually remember specifically when they pulled it out of the legislation. But yeah, that will be cut. I'd be surprised if it was delayed more than a year. But yeah, I will double check that for you. Kate, thank you for the question. Um, Another headline grabber, but actually, how many people will it affect? There might be some people in this room, but the mansion tax. The reason it's a headline grabber is because whenever you can give some sort of name to something, you can plaster that as a headline and it will grab attention. And mansion tax, I think, sounds interesting. It sounds like there's a huge tax rate going on. But this was much spoken about. Some of the rumours I heard a couple of months ago was going to be that if properties were worth over 500,000, there was going to be additional tax each year. And very quickly they sort of backtracked on that because they realised how unpopular that might be. So they've stuck with the mansion tax. So properties worth over £2 million will be subject to additional tax in the form of council tax. So it will just be payable along with your council tax, almost like a surcharge now. And I believe it was £2,500 for properties worth between over 2 million, and then over 2.5 million, I believe it was. I think that does ratchet up again to sort of something with 7.5 grand, something like that. All the details of these still need to be actually brought into statute and brought into law, and there will be consultations if you want a few bits of this. But the mansion tax, yeah, only really affecting those with properties over £2 million. Again, we've got a lot of clients and sort of looking at their property values. A lot of them will sit in between that sort of 500,000 to 1.5 million mark. It'll be a very, very small minority who do have a single property worth over that £2 million. But there might be people affected, and if there's not a lot you can do other than downsizing essentially. I pay the tax or downsize. That's ultimately the Chancellor's message here. And they were quite clear on this, to be honest, in the lead up to this, saying, if in fact I think Rachel Reeves retorted to one of the opposition who was heckling her. I think he said, if you've got a £5 million property, you can afford to pay this. That's the way things are. So there's not going to be many exemptions. There won't be any way of mitigating this. In terms of how the properties are valued, it will be done on the same basis that the council tax now looks at things. But yeah, ultimately it will be pay the tax or downsize. And people will be looking at the cost to move, etc. Then comparing it with £2,500 a year extra surcharge. Well, actually, that might be easy enough to swallow if you are living in one of those properties. Maybe not. Not for me to comment on, but yeah, that was one of the other headline grabbers. But again, when you put that into context, this probably won't affect everybody in this room. This isn't, the first thing we had up there, tax thresholds frozen for another 3 years. That will affect everyone. That's a tax. Everybody's going to have to pay slightly more. But yeah, the mansion tax is a very niche area that won't hopefully affect too many people. You'll see a lot of headlines about it, maybe, and a lot of talk about it, and a lot of people are very frustrated over it, and there'll be a lot of people arguing. But actually, whether it affects you or not, probably it will be in a minority. There was a question: if you have a joint cash ISA with your husband and wife, is the limit 24k? Yeah, each individual can put up to 12k into an ISA. So the overall limit to put into ISAs is 12k multiplied by, if you there's two of you, 12k each. For those younger participants in the room, there's been a freeze on the student loan repayment rate. So the threshold at which you will start to repay your student loan, has been frozen. Again, fairly similar. You're going to end up paying your student loan more because wage increases, if not more, which means more of your income is going to be subject to the student loan repayment. So around that sort of 28K mark, and then paying at 9% on any pound you earn over that. Um, I do look at this slightly differently to a tax rise because it is a loan. A lot of dentists will end up repaying their student loans anyway. So if they're repaying them earlier, they're going to be saving interest. So it's collecting more money quicker, and people will have to pay more. But if it's repaying a loan, then you're going to repay it faster, you're going to pay less interest. So it's not necessarily a negative. Those it will affect are those who won't repay their student loan in full and will have a balance written off after the 30 years, I believe it is. Um, those are affected because they're going to end up paying more, repaying more, so they'll have less written off. But as I said, most dentists, most associates earning kind of the average associate bracket, and certainly definitely practice owners, most will end up repaying their student loan in full at some point, with plan two student loans even. I mean, it could be touch and go depending on how they structure their income. But yeah, I wouldn't look at that as negatively, which is why I don't think there's been a huge amount of press on it so far. This was, I think, sort of snuck into the budget a little bit. And I think when I was watching the coverage this afternoon, I don't think a huge amount of energy was spent looking at this because it doesn't affect, shall we say, self-employed people, employees, working people. There's famously Keir Starmer had this definition of what a working person is because he wasn't going to put their taxes up. Um, so this didn't meet it bit into that bracket because what they've done is they've put tax on dividends, property, and savings income, so essentially investment income. They've increased the basic and higher rate by 2%. So instead of 8.75%, it's now 10.75%. Instead of 33%, now 35%. They haven't increased the additional rate, interestingly enough. It's just the basic and the higher rates that have increased by 2% for dividends, and likewise property with 20, so 20 to 22, 40 to 42, and likewise with savings income. Not a huge amount was made about this, but looking at my particular client portfolio, a lot of dentists trade using limited companies. And a lot of dentists also have rental properties in their personal name. Now, and we've already spoken about savings income, we've spoken about the ISA issue. This is a 2% tax increase. I mean, it's not income tax specifically, it's not tax on self-employed earnings or employed earnings, but it is a tax on dividends, which a lot of limited companies will be using to remunerate themselves. Um, so this is I think, a reasonably sizable 2%. I think it's a sizable enough increase to warrant attention and warrant more planning. In terms of planning, I think we need to look at, I mean, we look at this we should be looking at this every year. I think working out whether it's more efficient to pay dividends or bonuses. Depending on your exact company setup, dividends aren't always more tax efficient. Sometimes bonuses can be, depending on NI situations, etc., and other sources of income. With tax on dividends going up, I think that those calculations just need to continue to be done to work out what the most tax efficient way is. I haven't had a chance to run loads of numbers yet and loads of scenarios to work out when you would pay a bonus instead of dividends. So when I'm talking about paying a bonus, I'm talking about paying that through the payroll, so a salaried bonus. I haven't had a chance to crunch all the numbers yet. I'm sure Martin Lewis has probably beaten me to the punch, and lots of calculations already. But yeah, there will be a lot more cool to look at the specific numbers, specific scenarios to work out what's the most tax efficient thing to do still. And yeah, likewise, property income. Landlords just constantly being hammered. I think, for the last 10 years, we saw the mortgage interest restriction come into play where you don't get as much tax relief on mortgage interest. We've seen stamp duty rises on second properties, etc. And yeah, now tax on rental income has increased again. It is squeezing those margins on those with rental properties in their personal name. The planning aspect here really is, I think, if you've got a property already, I still don't think the 2% rise is enough to necessarily just warrant a blanket bit of advice to say to everyone, yeah, transfer your property into a limited company. Even that doesn't necessarily work because if you want the income out of it, you're going to take it as dividends probably, which are also affected. Um, but I think if you're looking at long-term investment particularly, I think if you're looking to build a portfolio of properties, there's a lot more reason to, if there wasn't already, a lot more reason to definitely look at a limited company model. Because if you're looking to invest long term and build a portfolio, then you're probably going to be leaving the money in the company, so the dividend tax doesn't really affect you too much. And yeah, you're going to be sheltering that property income in a company, so avoiding this extra 2% and leave it in the company to build up, and then you're going to then reinvest those funds. Obviously, exit strategies always need to be considered. Um, I think my biggest pet peeve at the moment is whenever I speak to people, particularly young dentists, they will straight away come off the back that, oh, I've heard a limited company is 100% the way forward. It's just better for tax, and that's not the case. You know, you have to plan accordingly, and limited companies are only appropriate in certain scenarios, depending on your exact situation. You know, depending what your spouse does, other sources of income, plans to draw money out, investments for the future, retirement strategies, lots to consider whether a limited company would be better or not. So I think just to say a blanket, yeah, property is going to be better for property now. Probably not best to say that, but I think it needs to be looked at, and those numbers still need to be crunched in the same way they have before. And this will probably just swing the balance in more cases than it was before. And savings income, we've already spoke about. Not a lot you can do there because savings income is going to be in your personal name anyway. And obviously, more savings income is going to come into this route now because of a smaller ISA limit. So, not a huge amount that can be done on savings income. Um, if you've got that money personally, you're not going to want to stick that money necessarily into a company. Um, you might, but ultimately you've taken it out of a company to begin with because you wanted to use it, and you wanted to invest it. So yeah, I think not a huge amount that can be done on that side of things, but just being aware of these increases. Like I said, there's still the savings allowances, etc. So supposedly 90% won't be affected, but I suspect quite a lot of dentists will be. So it's just building that in and being more aware that I think a lot of dentists now are on that cusp of maybe their interest won't have tax on it because it might be below a certain limit. But I think this is just going to push more people. The ISA cut definitely will push more people into it. And then with this increase, it means there will be some tax due on your interest. So just be aware of that if you do have large amounts of savings. And then quite a techie point. So there'll be a change to the ordering of income tax reliefs and allowances from April 27. Um, I won't go into all of the detail on this because we'll probably spend the entire webinar talking about it. But essentially, there is a way in which you have to allocate reliefs and allowances when you're doing a tax return. So you look at savings income, non-savings income, and employment income, etc. You look at these in a certain order, and the way you apply reliefs can be more tax effective in certain scenarios. And there's going to be a change to this. Now, in terms of the change, we have no idea what this looks like. There's going to be a consultation done next year. We're looking to roll this out from April 27. So we have no idea what this really will look like, but just be aware that you may have to. There could be a scenario where you end up paying more tax depending on how these changes are implemented. As I said, we don't know what they'll look like, but it's just something to be aware of. I thought it was an interesting announcement to make because there's obviously an angle here that they're going to collect more money somehow. So it'll be interesting to see if this is targeted at one type of earner or whether this was just going to be a blanket change which will affect a lot more people. For example, bringing dividend income, also bringing earnings, dividend income quicker. Dividend income is obviously taxed at a lower rate than other earnings. Whether they change things like that around, yeah, I don't really know where they're going with this, and it'd be interesting to see that. So keep your ears to the ground on that side of things. I think there was a question in the Q&A box. Bear with me. What year does the mansion tax come in? Again, I believe that is from next year, but again, I will double check that for you. I think I've tried to put dates in where they're deferred more than 1 year. I will double check that and get back to you on that question specifically. But yeah, I think when I've done these slides, I think to save me typing for hours on end, where things are delayed by more than 1 year, I'll put the date in. Where I haven't, it usually means it's going to come in from next year. I will double check the specifics for you on that one. And then just also of note, again, probably slightly more techie points, but things which will have an impact on some people in this room. So quite a lot of jargon on the screen there, but essentially that first bullet point is just saying that from April 2029, HMRC is going to try and collect more tax through PAYE than they already are. What that essentially means is that if you are on PAYE, so for example, if you have Oh, thank you, Chirag. It was April 28th, the mansion tax. So that was another delayed measure. Um, yeah, so from April 29, we've got the situation where if you have employment income, for example, maybe working hospital, still alongside your practice or associate income, and you're paying PAYE, they're going to try and collect more tax through your tax code. So you pay more tax, more will be deducted from your employment income throughout the year compared to what it is now. So they're trying to get their tax quicker. And they've been doing this for a little while, but they've been very specific about this, that they're really going to try and target a lot more. What this could mean, again, 29 is a long way away. There will be consultations on this. What I suspect this will mean is they may, if you have self-employment income and employment income, or dividend income and employment income, they might use last year as an estimate to work out what they should be collecting. Now, the problem is if your income goes up and down, you'd either have to inform HMRC of a big change, which is a pain. You're going to have to contact them a lot more, and things do change regularly. Or you're going to have a lot more tax collected from you throughout the year, and then you'd have to end up getting a refund at the end of the year. Or vice versa, they don't collect enough because they based it on last year and things have gone up, which is kind of the way things are at the moment anyway. So this is interesting of how they're going to operate this. Now, I didn't want to mention making tax digital today, but I will because I think it kind of feeds into this. So make those who aren't aware, making tax digital is a new way of filing self-assessment tax returns from next year for people who breach certain thresholds. So from April 26, people will have to, self-employed people, they're only self-employed, not people with companies, self-employed people will have to do quarterly tax returns instead of just one annual tax return. They'll do quarterly tax returns plus an annual filing to correct everything else. Which is a huge, huge change. And if you are self-employed and you haven't spoken to somebody about this, I would recommend speaking to someone very, very soon because April 26 is not far away, and this is an absolute seismic change in the tax regime. But my suspicion is that this announcement of POA income could feed into this. So where they're getting more regular information on self-employed earnings, they might use that information to determine how much to deduct through PAYE. Now, the issue with that is the quarterly filings could change drastically because they're slightly limited in what they're going to be, I think, to start with. So I think this will complicate the already overcomplicated tax payment system of keeping track of how much have you paid already, how much do you need to pay in advance, is there any back to you? I think this is going to overcomplicate it, but I'm willing to be proved wrong. April 29 is a long way away. They could work out a fantastic system, and I'll eat my words, but I am hesitant and slightly cynical of how this would work in practice. And the second bullet point on there um, is corporation tax penalties are increasing from April 2026. So hopefully there's no one in this room. Hopefully of all the attendees, you're all very, very good at filing things on time. If you are one of the perennial late filers and you go, it's only £100 filing fee, I'll deal with that. That is gonna double, and obviously any subsequent penalties will double as well. So do file on time is the advice there, and the best way of getting around that. And then just finally to wrap things up for the last 5 minutes or so, just a bit about the future. So what to expect now? Obviously, I don't have a crystal ball, but what can we expect? Well, I think this has laid the groundwork probably for future tax rises. There was a lot of pressure for them not to increase. So if we talk about the rises we have had, it's also fair to say about the rises we haven't had. So last year we had the capital gains increases, and April will see those in full effect from next year. We've had a partial increase this year, then there's another increase from April next year. So capital gains was already put up, so they've left that as is. Income tax, they said they weren't going to put up for working people, and they have sort of stuck to their word on that. But will that be needed in the future? A lot of rumours that they were going to put that up, huge, huge fiscal black holes, etc. There was a lot of fear that they were going to put taxes up for a lot of working people. They've done those freezes, but will they have to pull that lever at some point in the future? Will the measures they've done be enough? So can't say taxes are definitely going to go up, but I would still say, that second bullet point I think says it zero. Taxes are still relatively low, which means there's somewhere for them to go above potentially. Now, looking at the silver lining all of this, like I said, tax rates are still relatively low. And I know that there'll be some people when I say that who roll their eyes and say, Seb, what on earth are you talking about? How can you say that? We're talking in the context of historical tax rates. So at the moment, the highest tax rate for corporation tax is 25%. Even in my working lifetime, sort of 15 years ago, the highest rate of corporation tax was 28%, and even that was lower than what it was historically. So in the grand context of things, tax rates are relatively low, particularly capital gains tax still. Even though there's an increase coming next April, it is still relatively low, which I think still makes it attractive for sales and exit planning. I think if you are thinking of selling, then you know the next few years still isn't a bad time with tax rates the way they are, and they're not overly punitive on the sales side of things, um, which I think makes buying an attractive option because you're going to have people who want to sell potentially to make use of these rates, and most buyers, I think, will be hopefully in it for the long term, looking at long-term growth, etc. And maybe on the younger side, thinking, look, I want to have a practice for the next 10, 15, 20 years. And I would say you can't, whilst there are some taxes we like to try and plan as much as we can for, um, I would say planning 30 years in advance, you can get the structure right of things and plan for that far, but actually worrying about what the tax rate could be in 10, 20, 30 years' time, who knows what the government will be by then? We could have 10 governments in that time, and all the parties we're talking about might not even exist anymore. So planning that far ahead, I think that's one for I think for a buyer, I think tax rates are almost irrelevant to you in terms of capital gains, etc. You're just looking for the long term, and all the other rates are still low enough that I still think there's good income to be had and good opportunities, particularly on the limited company side of things. I think limited companies will get looked at a lot more now. I think obviously they've been squeezed for so long, but I still think there's enough opportunity for long-term investment for people looking for long-term growth. So I still think buying is an attractive option as well as selling. And yeah, that final point I think sums it up well. I think structuring and planning are more important than ever now. I think with tax rates looking slightly different to how they did say 5 years ago and various allowances looking different, I think you need to look at this annually. You need to look at this on a regular basis to work out are your affairs structured in the right way? Are you making the most of all of this? Are there small tweaks you can make that could make a big difference? I did a talk last night actually to a group of young dentists and sort of saying to them, yes, there aren't magic wands that we can wave that make all taxes go away, but there are still enough opportunities for small amounts um, to try and add them all up to make a difference. What I'm saying is, within limited companies, for example, there are lots of small little perks you can make use of, and when you can stitch all the little bits and pieces together and make use of all the allowances you've got at your disposal, or added together in aggregate, they're worth doing. But it's taking the time and effort to do it. It's not burying your head in the sand. It is tackling problems as opposed to ignoring them. So I think structuring and planning are more important than ever. And I would say it's worth regular conversations to make sure you're structured in the right way. And I think just a sort of a final point then is don't always be disheartened if you're told there's not a lot you can do. You know, we've been through all those points, been all the budget points, and there were a few of them you might have been frustrated that I said there's not a lot you can do. Well, that's good to know at least because at least you can emotionally move on from the scenario. What you don't want to do is bury your head in the sand and not know if you're doing everything right. What you'd rather do is just know, am I doing everything I can? Is tax the lowest I can get it? Fine. I can accept that I'm doing everything right, but you don't want to miss opportunities. So don't always be disheartened if you're told there's not a lot that can be done, because sometimes that just means you're doing things right, and it's good to know that you're doing things right. And I think that's a good point to end. I have got my email address up on the screen. I think there was a question in the Q&A saying about some contact details. So yeah, my email address is up on the screen. If you would like to contact me. As I said, as a thank you to Ollie and all the team at FTA, if people do have any queries about anything in the budget or anything finance related, I am more than happy to answer anything at all. Finance is one of those funny subjects, which is obviously very personal. So whilst I thank you for the three or four of you who did say something in the Q&A, and if there be a few more on the Q&A, that would be fantastic. But I appreciate there might be some personal questions that you'd rather ask behind closed doors, and I'm more than happy to deal with those questions too.
Thank you very much, Seb. That was, yeah, a really kind of concise way of looking at the budget, and yeah, I think it's really kind of showing, yeah, exactly how it's going to affect everybody. There's a lot of things like I know we spoke about before that may or may not, but it's like right, okay, these are the bits that yeah you do need to be looking out for. And I like the part at the end in terms of times like this, and we've seen it kind of before with COVID and the like, that maybe not they're not tumultuous times, but times of change are good for both buying and selling. That
Absolutely,
some
absolutely.
some need to or would like to sell to make use of the tax breaks and things that are available at the moment. But if you're buying for the next 5 to 10 years, and who knows what that's going to look like.
Yeah, exactly. I think that's the way to look at things. I think if everything stayed the same the whole time, it would be very boring for one, but also it would never present new opportunities because everything would be the
Yes.
same. You'd make use of opportunities you could, and things would never change. I think anytime there are rises or new allowances or anything that
Mm.
changes, it might be frustrating because this year there might be people who go, well, this none of this really is going to affect me other than some increases, which I can't get around. But for
Yes.
others, it presents opportunity, and I think, like I said towards the end, I think whilst tax rates are the way they are, so still relatively low. As I
Mhm.
said, I think there's room for them to go somewhere, which I'm not saying that's going to happen, but if they were
No.
going to go anywhere, that's really where the room. They can't go too much lower, with public spending where it is.
Yes.
So whilst I wouldn't bet my house that they're definitely going to go up, I would say if they're going to go anywhere, it would only be up. So it makes me think, this is that good time for opportunity. I think, yeah, particularly for sellers, but that also presents opportunities for buyers as well. Because you sort of forget sometimes about that because if you're looking way ahead of an eventual
Mm.
exit, 10, 20 years time, I think you can ignore a lot of this in terms of the immediate sales impact because it's just way too early to plan. So I think it
Yes.
presents, like you said, good opportunity. Crisis always presents good opportunity. Whilst I wouldn't say we're in a
Yeah.
crisis,
No, no.
things change. Things changing is enough to warrant looking at these things, and say,
Yeah.
what do I do? Because in a year's time, maybe we're doing this webinar again next year, and in a year's time, we could see some really quite large changes. I think the changes today have been quite small tweaks,
Yes.
nothing
Compared to
wholesale.
last year.
Absolutely. I think
Yes.
we've been spoiled, I think, in the last 3 or 4 years that we had the mini budget with Liz Truss and Kwasi Kwarteng. Then we had the
Yep.
unraveling of the mini budget. Then we had a new Labour government come in and want to put their
Mhm.
stamp on things. I think we've been spoiled. I'm sort of saying, sort of like tongue in cheek there, with huge changes, which are
Mhm.
interesting and exciting and grab your attention. I think today is a little bit more vanilla, shall we say, that there's nothing which makes people, I think, panic too much and also doesn't excite people too much, and that has the risk of people not taking note of it as much. But there's still plenty in there to
Yes.
plan for, and make sure you're doing things in the right way.
And I think from a confidence point of view as well, there's a lot of talk of what could have been
Absolutely, yeah,
in the past couple of months. So
absolutely. I think they did.
compared to what could have been, it's like right, okay, now we know what has happened. We can start moving forward, making some business plans and acting upon the known information rather than kind of hanging back or yeah, not
Exactly
moving.
that. I think the briefings and the leaks that have been used over, it was done last year and the year before, it's been done for a long time
Mm.
now, but particularly this year, I think there was a lot of borderline getting on hysteria of what tax hikes could there be,
Yes.
and a lot of people really getting quite frenzied about it and worried about it. And you can't plan with those emotions. You have to know exactly
No.
what things are, and that's crystallized now. We know what these are going to look like, and now we do know what they look like. Now we can plan at least for the next year or so, and that's all you can do. All you can do is plan with the information you've got. I think
Exactly.
crystal ball gazing can be a little bit dangerous. Let's work with the information we've
Yeah.
got. Let's actually put plans into action now because there are some definitive rates in there that we can work with.
No, exactly. And I think we do have a couple of questions that have come through
Okay.
on the Q&A whilst we've been talking. First one being, how should I consider restructuring paying myself salary from dividend at the moment
Yes.
from their limited company?
So, like I said, I haven't done all of the numbers yet, but I suspect for most people, I think dividends will still probably end up edging and being the most tax efficient way of paying yourself. But
Hmm.
in certain scenarios, you might find, depending on if you've got other sources of income, if there are other partners in your business, etc., I think the calculations needs to be done to work out is a bonus more efficient. So if you've got
Yeah.
private income, for example, you'll probably be claiming the employment allowance, which makes a big difference from an NI perspective. So if you've got ticking a lot of boxes, that it means that you could look at a bonus. You might find that could save some money. As I said, I suspect without crunching all the numbers in detail, I suspect dividends will still be more tax efficient, but I think it's worth doing those calculations. So instead of how should I consider restructuring myself, have a chat with your accountant and say, this is what I'm planning to remunerate myself across the next year or so. I think it's always good to have a 12-month remuneration strategy. This is what I'm planning on paying myself. What's the most efficient way of taking this out? Should I be taking this as dividend, salary, or a combination? And let them do the numbers and crunch the numbers and basically come back and say, look, this is based on what you're saying.
Yeah.
This is the most efficient way of getting that money out. I suspect it will be dividends still, but there'll be some scenarios where it might not be now.
Yeah, makes sense. Yeah, so it kind of depends on a case by case and kind of how much you're drawing
Yeah,
in
exactly
each.
that. Exactly that.
And then another one is, do I need to revisit my business cash flow and tax planning strategy? Assuming I've kind of got one already in place.
Yeah, absolutely. I think if you've already got one in place, that's fantastic. And I think
Mm.
actually these things are never made to be static. It's never meant to be just a historic task. If you produce these in the past or if you haven't done them at all, I think
Mhm.
it's a matter of keeping them up to date and always adapting them. I think the tax planning strategy could change quite drastically if you are somebody with large savings, large personal savings. So we spoke about the ISA cut and we spoke about the savings income increase.
Yeah.
If you've got other source of income which are subject, if you've already got dividend income, for example, or property income, then I think you would look at tax planning strategies and think slightly differently now. Um, because historically, I think, if you did have a limited company, for example, a lot of people would take money out of there because it was more advantageous to save personally. Well, that might now have swung the balance slightly. So, in terms of cash flows, you might look at leaving more money in the business. Costs could be going up in your business. So, for example, if you have got people on the salary sacrifice pension schemes, that could increase the cost of that for NI. So, yeah, I think it's always worth revisiting them. And I think this budget's actually a really good one where there's lots of small changes but actually,
Yes.
if you're in a certain scenario where they all affect you, that could add up to quite a bit. It may be the opposite. It may be that none of it affects you and you're fine. But I think rerunning those cash flows, tax planning, absolutely worth looking at.
And like you said at the beginning, I think when it comes to tax planning and especially business cash flow and bits, it's not a do it once in
No,
2012
absolutely.
and kind of, yeah, leave it. Obviously, with things like the budget, yeah, you do need to be revisiting them
It's standing on
as
shifting
often as you
sand.
can.
Yeah, I was going to say my favorite expression is standing on shifting sand. That it is
Mm.
constantly changing. It's never the same. These are fluid, and they're only as valuable to you as they are up to date. If you're looking at
Yes.
something from 2 years ago, well, that is vastly out of date now, and actually it is of fairly little use. You need to be
Mm.
looking certainly to the future the whole time. Historic data
Yeah.
is fantastic for some things, but largely it's that management information, that future data, where the value really lies.
Yeah. And what better time to change than when there has been a lot of little changes
Exactly
and you
that.
can get yourself fully up to date and
Exactly
then,
that.
yeah, kind of move on from there. Good.
Exactly that.
So we do have another question. Is it now marginal as to whether to run as a limited company? I'm about to buy a practice and still have the choice of my operating style.
I think it's definitely for the last 5 years at least, if not longer, maybe 10 years. I think limited companies have been targeted, and like we said, corporation tax rates have increased, employers' costs have increased, dividend tax rates have increased. So I certainly think, I mean, on a straightforward scenario, I did run the numbers last night without these increases, and anything above 60K, you're actually worse off with a limited company now if you want all of the money out. That being
Right.
said, that becomes a lot
Mhm.
more complex if you've got a spouse, and that's going to be a very straightforward single shareholder operator taking all
Yep.
the money out. As a practice or prospective practice owner, I think the thing to consider it all depends on your lending, because limited companies still work really well in shielding capital repayments. So if you're taking out a lot of lending to buy a practice, um, if you had that all personally, you're going to get taxed on the profits regardless of the
Mhm.
capital repayments on that loan, and that can kill a lot of businesses. So just to give you an example, if you had £150,000 of profits, but you had capital repayments of the loan of say 50K, you've got 100K cash total, but you're being taxed
Yep.
on 150, which means that after you paid your tax, after you paid the capital, you've got 100K less the tax on that, which could be quite a lot. And you'll find you've got very little money left at the end, and that can really make profitable businesses struggle from a cash flow perspective. Now, the beauty of the
Yes.
limited company in that scenario is that the company will pay corporation tax on the profits still. You
Mhm.
won't get any relief for the capital, but it can then make the capital repayments, and then what you take out of the business after that is basically shielding the capital from personal tax. So that's why, for a lot of the time, for practices, I think limited companies, highly leveraged limited companies, are still going to be the better option.
Right. Yes.
There needs to be more planning or remuneration strategies still because it's going to impact that. But I would suspect for prospective practice owner, I think it's going to be probably still the better option, particularly with goodwill values as high as they are and lending and
Mhm.
interest rates as high as they are still. I think that limited company will end up saving a lot more money that way. I think no borrowing or associates, for example, they might find the limited company is now more marginal. But yeah, I think it's worth obviously looking at and crunching the numbers. I think if you're buying a practice, these cash flow forecasts are your absolute lifeline. This is the way you know if it's going to
Yes.
work or not. And updating it for these changes to work out how to buy this practice, absolutely crucial still.
Yeah, no, yeah, I agree. Makes sense. So that we do have another one. So yeah, I'm selling a practice for around 800,000. On a high level, what would the difference in CGT and any other taxes be if it's sold before versus after April 26th?
Yeah, so it's broadly, I mean, just I mean, I'm more than happy if you want to email, I'm more than happy to really crunch some actual detailed numbers for you, but very broad strokes. The best way to attack with these things to make it relevant for everyone is if you're looking at a 4% increase in tax, depending on what rate you're prepared at it, if you're looking at a 4% increase in tax, for every £1 million of gain, you're going to pay an extra £40,000. So
Mhm.
you're selling it for 800k, which means the gain probably isn't that because there probably is going to be some purchase cost in there. So it's going to be an additional 4% on the gain itself. So I would say it's not small sums to be sniffed at. I think we can sometimes trivialize these things. 4% is still sizable enough, but it
Yeah.
wouldn't probably affect things too much. I'd say obviously if you can complete before April 26th, that would be the priority really. I think if that's doable. But I think you need to assess exactly where you are, and if you are planning, Ollie would be better placed to maybe advise on this.
Mm.
If you are trying to squeeze that sale through before, I think it's about being realistic, probably, and knowing where you are now, what needs to be done between now and then, 3 or 4 months. How realistic could that be? And I think obviously the agents, etc., will be much better placed to advise on that than I would.
Yeah, so I think from an agent perspective, it's yeah, have a chat whoever you're marketing with, or if it's a private sale, have a chat with the team that you're working with, find out exactly where you are, if if there's anything that's could delay the process. Because if you're very early on, it might be a tough push, if not possible, possibly before April. But if you are within the sales process, 100%, yeah, have a chat, see where you're at, and make sure that everyone is aligned to get you across the finish line before April, if you can. And then we got one more question saying is there a clever way to leave surplus cash in my business and get better tax treatment on savings, then take it out personally?
Yeah, I mean,
That's-
it's a very good question because it's a tough one. Because if you leave money within the business, you're always going to save tax because you're not subjecting it to dividend tax, and obviously, if you're planning to save it as well, you're not going to be subject to higher savings tax. Um, but what I always say, the big caveat to this is you're going to want that money at some point. And most of the time, leaving money in the business long term and then taking it out in a large lump sum is probably less tax efficient than if you'd spread that money evenly over a quarter a number of years. So it's a
Yes.
tough one because I think it will really come down to the exact nature of what your plans are, what your spending habits are, what you want to do with that money. I think what this budget does do, and I don't think there's probably going to be enough about this. I think naturally people will zoom in on the sort of the bad news. This budget really is trying to sort of double down and encourage growth within the economy, and encourage businesses to invest. And I think, if not necessarily a clever way, but if you're going to leave money within the business to shelter it from income tax or from personal taxes, then fight rather than just saving it within the business. If you found a way to invest and grow that money, that's probably the best way. That ultimately, interest rates are high, but if you've got potential for growth, more than that, and sort of businesses invest in, property invest in, etc., that's brilliant. That higher yield is probably going to be more tax efficient than the savings income. So I think not necessarily a clever way, but I think it's worth thinking about that. This budget was really aimed to try and stimulate growth and leaving money within the business to avoid those personal taxes. Finding a good use for it is probably the best advice I would give on that side. Um, in terms of if you are leaving surplus cash, I think nothing's changed in that respect. The best things within a limited company, if you've got lots of cash building up, is looking at investments, so looking at buy-to-let properties, buying more practices, you can build deposits up much quicker if you're going to leave them in the business. Obviously, private pension contributions, depending on your pension situation, and electric cars are still pretty advantageous. Those
Yeah.
benefits are being marginalised, but if you've got 50, 60 grand coming up and you need a new car, and it suits you, buying an electric car through a company is still a tax efficient way of using that money. So whilst it's not necessarily answering your question in terms of talking about the saving side to try and shelter that, I don't think there is a clever way of that. I think it's maybe just looking at other things you could be doing with that money. Because I think the saving side of it's, yeah, that's obviously been attacked, and I don't think there is a clever way around it yet. So I think the options you have, consider the other tax efficient ways of using that money.
Yeah, yeah, I agree. So it's kind of, yeah, keep it in the business as best you can. See if what else you
Yeah,
can do with it
exactly that.
from
Yeah,
that
and
perspective in terms of growth for the business. I saw that after the budget they'd predicted a percent growth over the next year, which has gone to 1.5.
yeah,
So
yeah. I
yeah,
think yeah
they're
that
predicting more growth than they expected.
yeah, like I said, I think this budget is really aimed at stimulating growth
Mm.
within the economy, and having these conversations kind of shows you what they're trying to achieve. They're obviously trying to raise more money with the Chancellor, but obviously the side effect of this is people want to try and avoid that. The way they're trying to encourage you to do that is by doubling down on the growth side of things, which again,
Yes.
great, I think great time if you are looking at buying practices. I think it's a great time to do that if you have those ambitions, building up a deposit in the company now rather than taking that money out to then buy that second or third or fourth practice. I think it becomes even more attractive after today's budget.
Yeah. So I think that is kind of wraps up all the questions we've had in the Q&A session, and we're knocking on 8 o'clock. So I think it's time to thank you very much, Seb, for
Super.
yeah your presentation and also putting this together so quickly for us.
No worries.
Yes,
Yeah, apologies.
and
The slides could have been they could have moved a lot more, but when you've got a few hours,
no,
it's
no,
just getting the
no,
information on the screen.
exactly. The information was what we're here for.
No, super. Thank you very much for the invite, Ollie. And yeah, I hope everyone's got something to take away from it all. And yeah, like I said,
Yes,
email addresses on the screen if people do want to reach out for any sort of confidential advice, which they do want to ask here.
yes, and we will also be sending out the entire recording to everyone that has attended. So you'll have that to kind of refer back to at a later date.
Fantastic. Well, yeah, thanks again,
Amazing.
Ollie.
No problem at all. And thank you to everyone that attended. And I'll see you all later.
Bye
Thanks.
bye.
Bye.